the author of truth. It is your son, Ange Fabrice Mahuri, coming before you today. As I open these ledgers, I surrender my hands and my mind to you. In Jesus' name, amen. Line by line, page by page, numbering assets, counting the cost, praying that no honest detail is lost. You bring clarity where there is confusion. You bring light where there is illusion. Guide my pencil, steady my heart. Let your wisdom lead from the very start. Lord, keep my debits and my credits true. In every transaction, let me honor you. Give me patience when the numbers don't align. Fill me with faith through your power divine. Walk with me in honesty. Keep my conscience clean. Let your ethical grace and my duties be. In the name of Jesus, I offer my work to thee. Pressure builds and deadlines are near. Cast out the anxiety, silence the fear. Grant me the patience to examine every line, to seek accuracy and wisdom divine. Protect my heart from temptation or greed. Help me stay faithful in word and in deed. For truth is my standard, and grace is my shield. To your Holy Spirit, my spirit I yield. Lord, keep my debits and my credits true. In every transaction, let me honor you. Give me patience when the numbers don't align. Fill me with faith through your power divine. Walk with me in honesty. Keep my conscience clean. Let your ethical grace and my duties be seen. In the name of Jesus, I offer my work to thee. You are the master of all accountability, the righteous judge of all reality. No worldly wealth compares to your praise, so I walk in integrity all of my days. Faith in the way, honesty always at the workplace gate. Lord, keep my debits and my credits true. In every transaction, let me honor you. Give me patience when the numbers don't align. Fill me with faith through your power divine. Walk with me in honesty. Keep my conscience clean. Let your ethical grace and my duties be seen. In the name of Jesus, I offer my work to thee. The book's about, the work is complete. I place all my efforts at your holy feet. in the name of Jesus, signed off by your son, Ains Fabrice Moher. Amen.
Hello, guys. Hope you're doing well. Now we are starting our course today. Hope we will be just starting where we stopped the last day. We are continuing to the chapter 4 of course. Now, what you have seen, remain in chapter 1 and 2, we used it to see the simplest possible forms of expressing emotions. Now, are continuing. We are continuing to the chapter 4, which is aiming at classifying the classified balance sheet and the related disclosure. Now, let's take a recall. In chapter 1, chapter 3, we discussed and illustrated the steps in the accounting cycle. They also discussed the concepts, assumptions, and the procedures that provide a framework for financial accounting as a whole. Now, this chapter 4, it will now expand, yes, it will expand uh, the content and presentation of financial statements as well, but also we'll just dive in deep the reinforcement and what has been learned in previous chapters and introduces the classified or classification grouping of accounts on the balance sheet. This is all of what we are going to see. Chapter 4, we are now on notes to the financial statements. When we say about related disclosures, these are specifically mainly related to the notes to the financial statements. The auditor's report and the management is a report which are all integral to meeting the disclosure requirements. Now, what the main objectives of chapter is now explain the importance of challenges related to basic financial statements, disclosure, as explained in the prepare, classify the balance sheet, explain the purpose and the content of the auditor's report. Yes. Now, we explain the purpose and the content of the report that describes management is responsibility for financial statements. We have the concept self-check, what you can check yourself. Use the following as a self-check while walking through chapter 4 at the end of the chapter. What shapes and limits an accountant's measurement of wealth? Are financial statements primarily intended for internal or external users? And what is a classified balance sheet? You can ask yourself. Then, what are the classification which within a classified balance sheet? What are the classification? You have to understand them and know them. And also you ask yourself, what are current assets? This is all of what you will be able to understand if there is a current, what are non-current assets, liability as well. Now, what is the current portion of long-term liability? What is the purpose and content of the notes to the what is the purpose and content of the auditor's report? What is the purpose and content of the report for financial statements? The purpose of these questions is to prepare you for the concept introduced in the chapter. Your goal should be to answer question as you read through the chapter. If when you complete the chapter you are now unable to answer one or more, the concept self-check questions go back through the content to find the answers because they are there. You can read yourself at home, can use them to ensure that you are fully understood the content. Now, solutions are not provided to this be self-checking. Now, 4.1, it is financial statement disclosure decisions. Statements information, yes, with a focus on the needs of financial statements users such as companies, investors, and creditors. Accounting information should make it easier for management to allocate resources and for shareholders to evaluate management. A key objective of financial statements is fairly present the entity's economic resources, obligations, equity, and financial performance. Fulfilling these objectives is challenging. Yes, accountants must make a number of subjective decisions how to apply generally accepted accounting principles. For example, they must decide how to measure wealth and how to apply recognition criteria. Now, they must also make practical cost benefit decision about how much information is useful to disclose. So some of these decisions are discussed in the following section that we are now making accounting measurement. Uh, Economists often define wealth as an increase or decrease in the entity to purchase goods and services. Accountants use a more specific measurement. They consider only increase and decrease resulting from an actual transaction. Yes. Uh, if a transaction has not recorded a change in wealth, the account of wealth is shaped and limited by the general accepted accounting principles introduced and discussed in chapter 1. Cost, the monetary unit, the business entity, timeliness, recognition, and going concern. These principles mean that accountants record transaction currency. For example, we can say here dollar. They assume the monetary currency retains its purchasing power. Changes in the on market value of assets are generally not recognized. Why? Because they are not the transaction in which has taken place, not as we wish. The entity is expected to continue operating into the foreseeable future. That is going concern concept. Economists, on the other hand, do not recognize change in the market value. For example, if an entity purchased rand for, let's say, 100,000 US dollar, that subsequently increased in value to 125 hundred thousands US dollar, economists would recognize a 25,000 US dollar increase in wealth. International financial reporting standards generally do not recognize this increase until the entity actually disposes of the assets. Accountants will continue to value the land at a 100,000 US dollar purchased cost. As I told you that we only record under historical cost. This practice is based on the application of the cost principle. I finished to tell you, which is a part of generally accepted accounting principles. Economic wealth is also affected by changes in the purchasing power of the dollar. For example, if the entity has a cash of, let's say, 15,000 US dollar at the beginning of a time period, and purchasing power drops by 10% because of what? Inflation. The entity has lost wealth because the 15,000 US dollar can purchase only 45,000 US dollar of goods and services. Conversely, the entity gains wealth if purchasing power increases by 10%. In this case, the same 15,000 US dollar can purchase 55,000 US dollar worth of goods and services. However, accountants do not record any change because the monetary unit principle assumes that the currency unit is a stable measure. Now, let's see qualities of accounting information. What are the qualities of accounting information? Financial statements are focused primarily on the needs of the external users. Financial statements, let me repeat it, are focused primarily on the needs of external users. We, as let's say a given company, internally they produce report for them to make comparison between years, through years, the past years, the current years in the analysis of variances. But the needs of this formation is primarily on the needs of who? Of external users. To provide information to these users, accountants make cost-benefit judgment. They use materiality considerations, to decide how particular of information uh, should be recorded and disclosed. For example, um, if the costs associated with financial information preparation are too high for, or if an amount is not sufficiently larger or important, business might implement a materiality policy for various types of assets purchased to guide how such costs are to be recorded. For example, a business might have a materiality policy or for the purchase of office equipment whereby anything costing 100, sorry, US dollar or raise is expensed immediately instead of recorded as an asset. It is recorded immediately as what? As an asset. In this type of situation, purchases of 100 US dollar or less are recorded as an expense instead of an asset to avoid having to record the depreciations expense as a cost benefit consideration. What we that will do what will not impact decisions made by external users of the business's financial statement. Here, in this type of situation, purchases of we remember uh, for the purchase of office equipment, they are telling us 100 US dollar is expensed immediately instead of recording as an asset. That is, they are telling us that is a materiality policy. You get here. This is a materiality policy of that institution. They say if an asset is purchased or we made an expense, whichever asset is being purchased less than that amount to should be expensed directly. Accountants must also make decisions based on whether information is useful. Is it comparable to prior period, as I told you? Is it verifiable? Is it presented with clarity and conciseness to make it understandable? Readers' perception of the usefulness of account information is determined by how well those who prepare financial statements address these qualitative considerations. Now, the accounting cycle and double entry accounting have been the focus of the preceding chapters. This chapter focuses on the presentation of financial statements, including how financial information is classified, the way accounts are grouped, and what is disclosed, what to disclose, what is being disclosed daily. A common order of the presentation of financial statements is this one. Ensure that it is under this way. We start by income statement. Normally, remember, after we come from ledgers, trial balances, uh, at the end of trial balances, we now start the income statement. Then we the second one is statement of change in equity. The third one is balance sheet. Why statement of change in equity comes before balance sheet? We have seen in chapter 2. Because within change statement of change in equity is here there we represent retained earnings. And retained earnings should be reflected in balance sheet, either to increase owner's equity or reduce the owner's equity if there is a net loss. If there is no retained earnings, now if it is negative, it will reduce the owner's equity. Now, statements of cash flow. This is the fourth one. Now, the fifth is not to the financial statement. That is related disclosure, as our chapter says. Now, in addition, the financial statements, the financial statements are now are often accompanied by an auditor's report. Yes, are accompanied by an auditor's report and a statement entitled management is what management is responsibility, because there should be responsible persons, while we are just each of these items will be discussed in this chapter below. Financial statement information must be disclosed for the most recent year with the prior year for comparison. Yes, there should be a comparison. Because why there should be recorded there? Because external users of financial statements have no access to uh, the entity's accounting records. It is important that financial statements are recognized in a manner that is easy to understand. Thus, financial data are grouped into useful and similar categories within classified financial statements. As discussed, let us see how what they are telling us that was done over there. Let's see the classified balance sheet. A classified balance sheet organizes the assets and liability account into categories. The previous chapters used it we have seen an classified balance sheet, which include only three broad accounting grouping: that assets, liability, and equity. The classification of assets and liability accounts into meaningful categories is designed to facilitate the analysis of balance sheet formations by external users. Assets and liabilities are classified as either current or non-current. Another common term for non-current is long term. You can say non-current, or you can say even long-term investment, property, plant and equipment, and intangible assets as well. The assets and liability classifications are summarized now below. Let us see how they are being classified. We see that assets, non-current or long-term assets, we have long-term investment, we have property, plant and equipment, and we have what? Intangible assets, legal rights, patents, goodwill, all of these are intangible assets. Now we have liabilities. Under liability, we have non-current or long-term liabilities. Let's move to current assets. Yes, current assets are those resources that the entity expects to convert to cash or to consume during the next year or within the operating cycle of the entity. whichever is longer. Example of current assets includes, look at cash comprising paper currency and coins, deposits at bank, checks, and money orders. Money orders, those are the um, money orders are those for example, promissory notes. It's a money order. Anything that guarantee you or the institution to have access or right to a given amount is a money order. Now, short-term investments. Now, the investment of cash that will not be needed immediately um, in short-term interest bearing notes that are easily convertible into cash. Accounts receivable that are due to be corrected within 1 year. Notes receivable, usually formalized accounts receivable, written promises. Yes, that's what I was telling you. To pay specified amount with interest and due to be corrected within 1 year, notably, or even 12 months. It's all possible. Merchandise inventory that is expected to be sold within 1 year, also they are current assets. Now, the current assets category also includes accounts whose future benefits are expected to expire in a short period of time. These are not expected to be converted into cash and accrued. We have prepaid expenses. Uh, prepaid expenses, they can't be converted into cash because already you have spent amount to someone in advance. We are not sure that he or she or we, whenever we need amount from that given person, we are not sure that we can get back this investment that or expenses that we have made. Yes, we have usually costing of advance payment for insurance, rent, and other similar items as well. Now, suppliers on hand at the end of an accounting year that will be used during the next year. At the end of an accounting year, these assets or what you have purchased will be used in the next accounting year. They are also assets. On the balance sheet, current assets are normally reported before non-current assets. They are listed by decreasing levels of liquidity, their ability to be converted into cash. Yes, their ability to be converted into cash. Therefore, cash appears first under the current assets heading since it is already liquid. Whatever you are going to sell, you are basing on what? On cash. You need cash. Whatever you are purchasing, whatever you are buying, starts from or end result is cash, either in the hands or at bank. Now, on current assets, and current assets are the assets that will be useful or sorry for more than 1 year. But it will be usable for more than 1 year. Both are the same. Now, they are sometimes referred to as long-lived assets. One can say non-current assets, other can say long-lived assets, non-current assets, or even fixed assets. Maybe within a non-current asset, we have fixed assets as well. Non-current assets include the property, plant, and equipment, items such as in the operations of the business, as some example of PP are land, buildings, equipment, and motor vehicles such as truck. All of these are non-current assets. Other types of non-current assets include long-term investment and intangible assets. Long-term investments are held for more than 1 year or the operating cycle and include long-term notes, receivables, and investment in share and bonds. Now, intangible assets are resources that do not have a physical form and whose value comes from the rights held by the owner. They are used over the long term to produce a sale product and service and include copyright, patent, trademarks, and franchise. Now, current liabilities. Liabilities are obligations that must be paid within the next 12 months or within the entity's next operating cycle, whichever is longer. They are shown first in the liabilities section of the balance sheet and listed in order to their due dates. They are chronologically listed with any bank loans shown first. Examples of current liabilities include bank loans or notes payables that are payable on demand or due within the next 12 months. Now we have account payables, of course, accrued liabilities such as interest payables and wages payables, unearned revenue or unrealized profit, the current portion of long-term liabilities. Yes, income tax payables is part of also current liability. Now, the current portion of a long-term liability is the principal amount of a long-term liability that is to be paid within the next 12 months. For example, assume 24 thousand notes payable issued on January 1st, 2023, where principal is repaid at the rate of 1,000 US dollar per month over 2 years. The current portion of these notes on the January 1st, 2023 balance sheet would be 12,000 US dollar, calculated as 12 months times 1,000 per month. The remaining principal would be reported on the balance sheet as a long-term what? Liability. Good. We have now non-current or long-term liabilities. Non-current liabilities, also referred to as the long-term portion of bond or a mortgage. Don't see whether you are just seeing me. Let me check back so that you can share. Good. Yes, I was saying non-current or long-term liabilities are also referred to as long-term are borrowing of a bank loan or mortgage. Mortgage liability that is secured by real estate. Now, equity. The equity section of the classified balance sheet consists of two major accounts. Here we have share capital and retained earnings. Now, the following illustrates the presentation of Big Dog Corp's classified balance sheet after several years of operations. Now, we are seeing that in let's say in 2023, data of 2023, we have cash, account receivable, merchandise inventories, prepaid expense. Then we have total assets, total current assets, property, plant, and equipment amounting to that amount. We have the second year as well. Now, after current assets, below current assets, there is non current assets. You have seen property, plant, and equipment is part of non-current assets. Now, under current liabilities, we have borrowing notes. Why borrowing note? Because borrowing notes is not, we have already borrowed something, notes, those amounting to 39. Now, account payables amounting to 24 in 2023 and 22, 2022. You see, there are two consecutive years, 2022 and 2023. Now we compare this information for us, for management to take suitable business decisions. Now, borrowing costing, account payable, tax payables, total current liabilities amounting to that amount. Now, long-term liabilities, borrowings. We remember we have notes. Uh, Notes. Look at. We remember these notes are mentioned there. You should refer to the question. Now, you see that we have after total current liabilities, we have that amount of long-term liabilities. Now, notes are included at the end of the financial statement among other purpose. They provide detail about a particular category on the balance sheet or income statement. Remember, our chapter says the classified balance sheet and related disclosure. That is chapter 4. Now, when we are, why there's a notes, you see, we'll see these notes. Those are related disclosure. We have to disclose for someone who do not understand how this data have been calculated. You write notes, then the note will be explained in a footnote. The balance sheet can be presented in the account form, yes. Balance sheet as shown above, where liabilities and equities are represented to the right of the assets. An alternative is the report form, balance sheet, where liability and equity are presented below the assets. Now you see the classified income statement. Recall that the income statement summarizes a company's revenues less expenses over a period of time. An income statement for BDCC was presented in chapter 1, you remember, as compared below. It was the same as this one. Now, you see, for the month ended January 31st, 2023, we have revenues, which is repair revenue. Remember, our business main entity was car repair and motor repairing of machine, motor vehicle repair and related services. Now they are saying the revenue or repair revenue was amounting to 10,000 US dollar, less expenses of rent, salaries, supplies, fuel, and fuel amounting to that amount. Now, net income, we subtract this 10,000 minus expenses. Then we remain with 2,200. Remember, let's go back in chapter 1. for you to recognize, you remember where we found 200, 2,200. In chapter 2, 2,200. Was it in our chapter? If not two, it was chapter 4, chapter 3, sorry. I see. Let us see. 2,200. It was net income, but they are included. Good. This is journal. You have seen them. Yes. Now, you see, let us back here. You see, we have repair revenue of 10,000. Then we subtract days expenses. We remember to subtract 200 of dividends. That's why we remain with how much? With only 2,000. It was 2,200, but the 200 are for dividends. That's why we continue. We can continue. This is what I wanted to show you, that net income, despite this one, we will be able to see now. Right, we will be preparing the next statement you have seen is um, the statement of change in equity, which will provide us the logic why we will remain with 2,000s only. Let's continue. I wanted to show you where those two, not don't be confused. We will see that in the statement of change in equity as well. Now, regardless of the type of financial statement, any item that are material must be disclosed separately so users will not otherwise be misled. Materiality is a matter for judgment. Office supplies of let's say 2,000 US dollar per month used by BDCC in January 2023 might be a material amount and therefore disclosed as a separate item on the income statement for the month ended January 31st, 2023. If annual revenue grew to 1 million US dollar, 2,000 US dollar per month for supplies may be considered immaterial. Why? Because they are too short. Imagine one thinks of 1 million. We are counting assets of 1 million. You are counting to 200,000. It may be considered immaterial. These exemptions, expenditures, sorry, would be then be grouped in with other similar items and disclosed as a single amount. As an integral part of its financial statement, a company provides not to the financial statements, of course, in accordance with the disclosure principle, not to the financial statements, provide relevant details that are not included in the body the financial statements. For example, details about property, plant, and equipment are shown in the note 4 in the following simple notes to the financial statement. The notes help external users understand and analyze the financial statements. Although a detailed discussion of disclosures that might be included as part of the notes is beyond the scope of an introductory financial accounting course. A simplified example of notes disclosure is shown below for Big Dog Coral Corporation. Notes to the financial statements for the year ended December 31st, 2023. Nature of operation. The principal activity of Big Dog Coral Corporation is the servicing and repair of vehicle. We have seen this. Now, general information and statement of compliance with IFRC. Big Dog Corporation is a limited liability company, incorporated and domiciled in Canada. Yes, that is should be reported where address of the company is the registered office and the principal place of business is they are telling us where the street address that they are saying now shares are listed on the Toronto Stock Exchange. We have Rwanda Stock Exchange here. Everywhere they have their own stock exchange. Where company goes to market to buy shares or even sell shares. They may be selling shares, and they may be buying shares as well on the market, on stock exchange. The financial statements of Big Dog Corporation have been prepared in accordance with International Financial Reporting Standard as issued the International Accounting Standard Board. The ASB is the body which produce IFRCs and IAS. Now, the financial statements for the year ended this 1st December 2023 were approved and authorized for issue by the Board of Directors on March 17, 2024. Remember, that interval between is that period after the reporting period, we might be having some adjusting or non-adjusting events over there within that period. Now, third, summary of accounting policies should be also included in notes to financial statement. The financial statements have been prepared using the significant accounting policies and measurement bases summarized below. We have revenues. We list everything that we have done within our financial statements. We have revenues. Revenue arises from the rendering of services. It is measured by reference to the fair value of consideration received receivable. B. Operating expenses. Operating expenses are recognized in the income statements upon utilization of the service or at the end of their origin. Act of rent, salaries, supplies, fuel, and fuel amounting to that amount. Now, net income, we subtract this 10,000 minus expenses. Then we remain 200, 2,200. Remember, in chapter 1, for you to recognize, you remember where we found 2,200. Chapter 2. One. For you to recognize, you remember where we found 200, 2,200. Chapter 2. For you to you remember where we found 200, 2,200. For you to you remember where we found 200, 2,200. For you to you remember where we found 200, 2,200. Okay, I hope now we shall continue. It was a network issue. We're back. Now you see there's two the interest dividends that we have to pay on share holders as the reward for the investment. Now we continue. The why I backed here is to ensure that there's the source of those 2,200 is very clear. That you see here, here we have dividends, and we have managed to say them that these dividends of 200 should be subtracted from those 2,200. That's how I was telling you. Okay, I wanted back to in chapter 1 so that you can recall it. Now you see the source of those 2,200. Now they're saying that the format used above was sufficient to disclose relevant information. Yes, or big dog code quark. I have told you. Now I was on not to the financial statements as an integral part of its financial statement. A company provides notes to the financial statement in accordance with the disclosure principle. Notes to the financial statement provide the relevant details that are not included in the body. Yes. In the body that is not disclosed in the body, of course, because this note to the financial statement highlight what the numbers, the figures in the financial statement have not disclosed. That's why they are unnecessary. They are part of financial reports. Most of the time in private institutions, they use this way. As for the shareholders, you can't produce a financial report without not two financial statements unless you don't have shareholders because they need this information. What are the company policies? Hmm? What are the bases in accounting? For instance, detailed statements are shown there, not for in the not the following example is what possible not a company may produce. Look at here financial statements not to help external users understand and analyze the financial statements that may be included as part of the notes is beyond the scope of an introductory financial accounting course. A simplified example is this one. not to financial statements. Okay, that's the car works corporate, that's company we used it to account for. One here they say nature of operations. You have to disclose what's the nature of operations have your company being done. Have you changed the nature of the operation? The principal activity of the organization should be done. What is your institution is doing? Is doing the principal activity of big dog work here is the servicing vehicles. That is not number one. The second one, general information and statement of compliance with IFRC. Big Dog Corporation is a limited liability company incorporated and domiciled in Canada. It's registered office, you can say a street address, whatever. The financial statement of a big dog is have been prepared in accordance with international financial reporting standards, as issued in the International Accounting Standard Board (EASB) that's produced a IFRC. The financial statement of the year ended December 31st, 2023. They are saying we are approved for issue by the board of director on 17th, 2024. Why March 2024, not 31st December? We have told you that there is a given period of time the management have to produce financial reports. They wait for approval, they make authorization, then whatever transaction that occur meanwhile under the years 10 events after the reporting period. Years 10. And that, remember, we have adjusting events and then an adjusting event. Only adjusting events are just being replacing the other one. But if there is no adjusting events, they stand still. You don't touch the report. Now, summary of accounting policies. The financial statements have been prepared using the you look at here the arise from the rendering of sources. It is measured by reference to the fair value of consideration received or receivable. Now, second, operating activities. The operating activities or expense are recognized in the income statement upon transaction of the service or at the date of their origin. When the transaction occurs, it's okay. In the accounting period, it's okay, you record. Now, borrowing costs directly attributable to the acquisition, construction, or production of property, plant, and equipment are just capitalized during the period of time that is necessary to complete and prepare the assets of its intended use or sale. Or borrowing costs are expenses in the period in which they are incurred and reported as interest expenses. Yes, they are recorded as interest expenses under the statement of revenue and the expenditures. Now we continue. The equipment and the order for use of production or in a production or administration is stated at cost, of course. Historical cost concept has told you. And now, other property, plant, and equipment are initially recognized at acquisition cost directly attributable to the bringing the asset to the location and the condition necessary to be employed in operations, to be used in a business activity or in a given institutional operations. Now, measured using the cost model, historical cost concept has told you cost less subsequent depreciation. Depreciation is recognized on a straight line basis to write down the cost net of estimated value. The following useful lives are applied. Boarding, when we are talking about useful lives, what do you mean? What do you get about the useful life? The useful life is a period at which an asset is expected to bring benefit to the organization. That is what we call useful life. Here they are saying buildings is 25 years, equipment 10 years, truck 5 years. Now, residual value estimate and a useful life are updated at least annually. Any change should be reported or be under the document named Article of Association or Memorandum of Association, but mainly in an Article of Association. Every company, it's a mandatory that it has or it should be having an Article of Association whereby all company policies are initially stated. Now, income taxes. Current income tax liabilities comprise those obligations of financial authorities, yes, relating to the current or prior reporting periods that are unpaid at the reporting date. Calculation of current tax is based on tax rates and tax laws that have been enacted or substantively enacted by in the end of the reporting period. Now, share capital represents the nominal value of shares that have been issued. Now, we have another thing that we call uh, an estimation uncertainty. Estimation as uncertainty. When preparing the financial statement, management undertakes a number of judgment estimates and assumptions about the recognition and measurements of assets, liabilities, income and expenses, information about the estimates and assumptions that have been the most significant effect on the cognition and measurement of assets, liability, incomes, and expenses provided. Let us see how they are now. We will be seeing the way they are. Actual results may be substantially different. Why? Because remember, it's an estimation, and we estimate an uncertainty. Things that we are not sure that will happen, they may be happening or even not. That's why the actual results may be substantially. They may differ from what you have planned. That's um, a default. It's obvious that to issue. So it's not a static that with the estimation projections will be actually happening. Never. It's not. It is not. It's unusual. It's unusual. It's unusual to be happening. So, property, plant, and equipment details of the company's property. Their carrying amount as December certificate now as for there. Look at. You see, I have managed to store to show the table that we have land, but land, remember, land is not being, it can't ever be depreciated. We depreciate building equipment truck, but we don't touch land. Land is value. See, value every year. So either we have revaluation accounting of it, but we can't account on depreciation. Mm. Now, or we have buildings. Now we have just starting by the opening balances. In 2023, we have the closing balance of 2022. Now the opening balance in building was zero. We have no land in 2022, but we had the equipment. We had what? A truck. This were the, the, the value that we brought in 2022. Now we add what we add. We add something we had purchased as well. Now we have purchased the what? 30,000. We bought rand in the 2023. Yes, adding to zero. Now we have 30 as total. Now we purchased also building. Either purchasing or building. You can build the buildings. You can even purchase building. You don't know. They didn't mention the activity that I've done already. Yes. But what we know is that there is an increase in the value of building, of course, that is equal to 90,000 US dollar, which is automatically to 90,000 as a total as well. Now, equipment is a we've brought a balance of 3,000 US dollar in 2023. But to purchase anything regarding equipment and the truck as well. A truck was 80. Good. Now, we took the total of what we have in this year, which is equal to 131,000 US dollar. Now we finish the carrying amount. We have a gross carrying amount, but we have to reduce the depreciation. We had of that. I told you that there is no depreciation of land. Please, no depreciation of land. Never dare to add anything in the depreciating land negative. Now, in a building also we have zero as closing balance, but this year we have purchased the building. But building, why building depreciated? Building differ to land. Land can't be depreciated, but building, painting, no, can be the there may be fire, there may be or the painting, even making creation and what maintenance. You can maintaining the building, yes, by maintaining building, just because you maintain them because they depreciate. There, it's understood. Then 3,500 US dollar, no, 45 US dollar, 240 US dollar for each element here mentioned. We may remember that we have to brought back what we call accumulated depreciation. Remember, they are telling us they have given us the accumulated depreciation, of course. Here on equipment it was 90. You see, it was 90 on equipment. On track, it was to 480. Those they brought a total of 570. That of last year, we don't bother there, but we the precision for there have to accumulate this one 3,785. Good. What the necessity element here is to calculate the depreciation for the carrying. Take into account and the past or accumulated depreciation from previous years, my friend, so that you can add accumulate them. Now that's why by knowing the carrying amount, yes, by carrying amount of our equipments, we will now do this. We take the general gross carrying amount after knowing what we have purchased or what we have disposed. It is possible that we can dispose an asset there. After disposing an asset, we reduce the value of it. Not if we, for example, we should be having a we should raise here. We should insert a raise instead of addition. We raise disposal. When there is a disposal, we add raise, then we dispose our assets. The value of disposition will impact negatively the balance at the end of that given period. Considering what we have there is that we have 30,000 US dollar as land. Now we have 90,000 in building, but we have to reduce 3,500 of the depreciation of the current year. Now, $3,000 US, but we have an opening balance of 90. We remove first 90, and we second we remove 45. Or in a simple, you add there's a depreciation of all of them together, then you take 35, yes, then you 3,000, then you remain with your 265 as a balance carrying amount at December 31st. Now, we have what also we have a track 8,000 today as per the depreciation for the year Now we add it to 480, it gives a total of 720. This 720 is being reduced from 80,000. Those we have 780. No, it is a big, give us a gross total property, plant, and equipment. They are telling this amount to the amount of PP shown in the assets section of BDCC's balance sheet. Now you see them. Now borrowing included the following financial liabilities. Rating to loan is being pressed there. That's why I have called the mortgage. Mortgage is an essential element. We have to consider that. Why mortgage? Mortgage is mainly relating to buildings and construction of the company's assets, long-term fixed assets. Yes. Now, on mortgage, because it's a big contract or it's a big investment, we have to take a certain proportion of, well, for example, we have a 163 thousand US dollars. This is a huge amount. You remember this is counting in the US dollar. This amount should to avoid high obligations or big where big to be a buy Biden, yes, Biden to the company will be paid each year starting from 2023. You see we have 5 to 38,000 so that it will reduce our run run. That is very huge for companies safety concern concept. That's one of the things that I want to ensure that we have to take a proportion in a given big run so that it will be paid each year consecutively so that it will not. They are saying in this note that the bank run is due on demand and be interest at 6% per year. It is secured by accounts receivable and in the inventories of the company. Now, the shareholder loan is due on demand, non-interest bearing and security. The mortgage is payable to First Bank of Capital Roy. The Capital Roy is one of the company on the banking institution in Canada. That is why they are telling they are advertising their banks. I don't know. Their books, no problem. Now, it will be interest of 5% per year, and it's amortized over 25 years. Yes, the loan is house
How easy?
a lifespan of a given period of time. Yes. Now, the mortgage, the mortgage is payable to First Bank of those monthly payment including interest rate interest. So not interest rate, but the interest. They didn't mention that. 960,000. It's 960,000. It is secured by land and boarding of owned by the company. They are saying that it was owned by the company. Yes, which is being secured by that company as well. The term of the mortgage will be renegotiable in 2023. Remember, this is related disclosure. When we are talking about related disclosure, anything that is not, it is very difficult to disclose it in a financial report. You have to add into these notes to financial report. It is very crucial element in the financial report because it helps external users of information what is going in the company. Everything regarding the company is just there stated in this press. This press is reserved for information That is qualitative information that can to be quantified but necessary for the company, for the smooth moving of the company, so that the owner of the business or anyone who need to know the information of the company will now no need for much more explanation. Here they are clear. Now, share capital. The share capital of Big Dog Car clearly consists of fully paid common share in the statement value of $1 per each share. That what does it mean? This means remember we have 10,000 US dollar in chapter one. We have seen the company information. We have seen that they are 10,000 US dollar under equity, under share capital. That means we have 10,000 yes, shares, 10,000 shares. 10,000 US dollar equivalent to 10,000 shares, because they are telling one share cost $1. All shares are eligible to receive a dividend, have their capital repaid, and represent one vote at the annual shares holders meeting, annual general meeting of the shareholders. There were no share issued during the period into account. Now, auditors report. That's crucial. Auditors report. Financial statements are often accompanied by an auditor's report. An audit is an external examination of a company's financial statements, information, and its system of internal controls. Now, internal controls are the processes instituted by management of a company to direct, monitor, and measure the accomplishment of its objectives. This includes the prevention and the detection of fraud and error. An audit seeks not certainty but reasonable assurance that the financial statement information is not materially misstated. Yes, the auditor's report is a structured statement issued by an independent examiner, usually a professional accountant who is contracted by the company to report the audit's findings to the company's board of directors. An audit report provides some assurance to present and the potential investors. What the potential investors might be wondering to invest in your company. What got them assurance? That's and the creditor that the company financial statements are trustworthy. Therefore, it is a useful means to reduce the risk of their financial decisions. Now, an example of an unqualified audit report or VDC is shown below, along with a brief description of each component. Put in simple terms, an unqualified audit report indicates that the financial statements are trustworthy, and a qualified audit report is the one that indicates the financial statements are not or may not be trustworthy. It is really difficult for the lenders to give you the road. The audit is independent from the company's stated. Yes, independent auditors report. They write them. The auditor's independence from the company is stated. There is no relationship between the audit and there are no conflict of interest between the auditor and the company being audited. And it is even prohibited that the auditor should, if there is a record that auditor did or have done that company, in this case there is a familiarity threat. Even auditor should not be having shares in the company. Now let us move. It's another issue with the auditing. It's not part from this, but we are just analyzing what the audit report is. The audit report is addressed to the board of director of Big Dog Corporation, or we say here, better names. You can insert names. This is what you see is that the form, what audit report should contain. The audit information is described. The auditor can say, I have audited the accompanying financial statement of Big Dog Corporation, which comprise the balance sheet as at that date, the income statement, statement of change in equity, and statement of cash flow for the year then mentioned, and a summary of significant accounting policies and other explanatory informations. Management responsibility for the financial statement is illustrated as well. Now, management is responsibilities are described. Management is responsible for presentation of these financial statements in accordance with the given territorial institution, the accounting principle, and for such internal control as management determining is necessary to enable the preparation of financial statements that are free from material misstatement, whether due to fraud or error. Also, responsibilities, the standards are described there by saying that my responsibility is to express an opinion on financial statements based on my audit. I conducted my audit in accordance with the territorial institution to which is concerned there. Those standards require that I comply with ethical requirements and plan and perform the audit to obtain reasonable assurance about whether the financial statements are free from material misstatement. Now, the audit procedure are described in general terms. There should be described the word so that an audit involves performing procedure to obtain audit evidence about the amounts and the disclosures in what disclosure in the financial statement, because they disclose everything. The auditors are responsible for disclosing whatever going in the business. Now, the procedures selected depend on the auditor's judgment. Auditor he is responsible to determine which procedure is going to use, depending on the methodology, the sample size of the data to be assessed. If the thing over there is just now, you can see that including assessment of the risk of material misstatement of the financial statements, whether due to fraud or error. In making those risk assessment, the auditor consider internal control relevant to the entity's preparation and fair presentation of the financial statement. When there is a strong internal control system, the audit is easy. But when there is a weak internal control system, it affects the audit work. Audit work become tough. Now, you see that the auditor consider internal control, I've told you, and fair presentation of financial statement in order to design what audit procedure. Audit require procedure that are appropriate in the circumstances, but not for the purpose of expressing an opinion on the effectiveness of the entity's internal control. An audit also include the evaluation of the appropriateness of accounting policies used and the reasonableness of accounting estimates made by management. as well as evaluating the overall presentation of the financial statement. A conclusion about the adequacy of audit evidence is stated now there. I believe that the audit evidence I have obtained is sufficient and appropriate to provide a basis for my audit opinion. That is the auditor. The auditor now say an opinion is expressed about the financial statement information. In his opinion, the financial statement present fairly in our material aspect the financial position of that company and its financial performance and its cash flow for the year then ended in accordance with territorial institutions. Now, the report is signed by the auditor and dated. You see, he signed, date, and the address. That is management responsibility for the financial statements. Now, the final piece of information often included with the annual financial statement is a statement describing management's responsibility for the accurate preparation and presentation of financial statement. You see, this statement underscore the division of duties with the publication of financial statement, management in responsibilities for preparing the financial statements, including estimate data and underlie the accounting numbers and example of an estimate in the useful life of long-lived assets in calculating what depreciation. You see, the independent auditor is responsible for examining the financial statements information as prepared by management, including the reasonableness of estimates and then expressing an opinion on their accuracy. In some cases, the auditor may assist management with aspects of financial statement preparation. For instance, the auditor may provide the guidance on how a new accounting standard will affect financial statement presentation or other information disclosure related material. However, the preparation of financial statement is a what responsibility. The preparation of financial statement is management responsibility. Here, this is clear. Now, an example of a statement describing management responsibility for the preparation and the presentation of annual financial statement is now shown there. You see, management responsibility for our aspect of financial statement representation and disclosure is expressed, stated. The accompanying financial statement of the company are responsibility of management. They think, hope it's clear. The financial statements were prepared by management in accordance with accounting principle generally accepted in that territorial institution on a consistent basis and conforming all material respect with international accounting standards. The significant accounting policies which management believe are appropriate for the company are now described in Note 3 to the financial statement. You see, everything they write them. Management responsibility for estimates, usage, and the maintenance of internal control is now acknowledged. Everything management is responsible for the integrity and objectivity of the financial statements. The auditor only comes to see that you have just done. The auditor will not come to prepare for you financial statement. He come to monitor whether you have fully obeyed the laws while preparing your financial statement, but not coming to prepare it for you. Estimates are necessary in the preparation of these statements and based on a careful judgment have been properly reflected. Management has established systems of internal control, yes, that are designed to provide what? Reasonable assurance that assets are safeguarded from loss or unauthorized use. Unauthorized use. You might be having a car of the company, then you are driving it to school for your children. That is an unauthorized use. Is being used for the business purposes or they are used for personal purposes? And to produce a reliable accounting record for the preparation of financial information, my friend. Now, you see, the board of directors and audit committee respective role are now explained. The board of directors ensuring that management fulfills its responsibility for financial and internal control. The audit committee of the board, which is comprised solely of directors who are not employees of the company, of course, is appointed by the board of directors annually. The audit committee of the board meets regularly with financial management of the company and with the shareholders independent auditor to discuss internal control audit matters, including audit scope and audit recommendation and financial reporting issues. The independent shareholder auditor has unrestricted access to the audit committee. The audit committee reviews the annual financial statement and the reporting to the board and makes recommendations to their acceptance. The audit committee also makes recommendation to the board with respect to the appointment and the remuneration of the company's auditor, of course. Now, managing knowledge is obligation to oversee all aspects of the company operations in the ethical manner. Management recognizes its responsibility for conducting the company's affairs in compliance with establishing the financial standard and the applicable laws, and it maintains proper standards of conduct for its activities. The officer responsible for the financial affairs of the company signs and dates the statement. Now you see this is for the what body. Everything is that is signed. Now summary chapter 4, we are almost done. The objective of financial statement is to communicate information to meet what? To meet the needs of external users. This is what I have told you before by starting this chapter. In addition to recording and reporting verifiable financial information, accountants make decisions regarding how to measure transactions. That first, applying generally accepted accounting principles can now represent challenges when judgment must be applied, as in the case of cost benefit decisions and materiality. Yes. Now, explain and prepare a classified balance sheet. Of course, a classified balance sheet groups assets and liabilities as for. We have to see assets, undercurrent assets, and the current liabilities. Current assets, property and equipment, long-term investment, tangible assets. We have seen that current liabilities comes first, then current long-term liability comes second. Now, those what we have seen. In accordance with the generally accepted accounting principles, or fully disclosed or relevant data not contained in their body of financial statements are now included in the company's notes to financial statement. This is what you have finished to see. Notes would include a summary of accounting policies detailed regarding property, plant, and equipment, assets, and specific about liabilities such as the interest rates and the payments terms. Explain the purpose and the content of auditor's report. Yes, auditor's report, you have been seeing that on an audit, as it relates to the auditor's report in an external examination. We have seen them. Now, hope it's okay. We are done. Next chapter will be accounting for the sales of goods. You will allow me to end by here today, and then we are just, it was not an easy task, but we thank God that we are done. Next, we will be seeing that chapter, and I hope that everything is clear. What's clear is that we understand the common sense of accounting, the way of recording. In chapter 3, we have seen practical application. Today, we have tried to understand after recording, after reporting, after we just make those transaction. What is the effect of those transaction to our business? what's the relationship between management audit these customers and to their effect and what relates to them to the external users of accounting informations so that everyone in the company understand where what's going on in a company without just asking in words. Because if I, for example, that one you have seen of uh, not two financial statements is just aimed at clarifying qualitative informations that non-qualitative information or quantitative accounting reports are not mentioned. So that's now easy for us or for the users of accounting information, of course. Now I think it's okay for today. I think think today it's okay. We can now end the course by here. Thank you. See you in the next chapter 5.
Mari on the track. Yeah. One big group, multi-company vision. Line by line, bringing balance with precision. Parent at the top, yeah, we holding control. Let's combine the numbers and construct the whole. Parent at the wheel, control is 99. Subsidiary numbers be at them.
We are now done. We will launch the next session on Saturday. Better use this one in the next session.
One big group, multi-company vision. Line by line, bringing balance with precision. Parent at the top, yeah, we holding control. Let's combine the numbers and Mari on the track. Yeah. One big group, multi-company vision. Line by line, bringing balance with precision. Parent at the top, yeah, we holding control. Combine the numbers and construct the whole. Parent at the wheel, control is 99. Subsidiary numbers be at them line by line. SCI gets that share, yeah, we show them some respect. And the minor influence, that's the equity effect. Cancel out the internal, wipe away the noise. Through financial statements, that's the real big flex, boys. Start with the parent holding 50 plus 1. That's control, step inside. Now the takeover's done. Got a subsidiary rolling under the umbrella. Consolidation time, let me break it down, fella. Rule number 1, take the revenue and cost. Add them 100%, no details get lost. I'll set for asset liability to match at the whole balance sheet. Every single patch, hold up, don't double count the intercompany trade. Cancel out the sales and the management fees paid. The parents sold a sub and they kept a realized gain. Eliminate the profit or the margins won't stay sane. Parent at the wheel, control is 99. Subsidiary numbers, we add them line by line. SCI gets that share, yeah, we show them some respect. And the minor influence, that's the equity effect. Cancel out the internal, wipe away the noise. The financial statements, that's the real big flex, boys. Now, what if we don't own 100% of the piece? Into NCR, not controlling interest lease. They own that remaining bit, 20 or 30%. Show the share in equity, where their money went. Now look at company 3, we got significant influence. Got 20 to 50%, not control, just a footprint. That ain't a sub, that's an associate in the net. No line by line added, that's a standard you reset. IS-28 equity method on the scene. Start with initial cost, keep the ledger fresh and clean. Add our share of the profit to the single line asset. Subtract dividends paid, that's the way that we pass it. Calculate good goodwill at the acquisition date. Consideration paid, that's the fair state. Minus net identifiable assets on the sheet. If it's positive goodwill, now the picture is complete. Parent at the wheel, controllers 99. Subsidiary numbers, we add them line by line. And see, it's their share, yeah, we show them some respect. And the minor influence is the equity effect. Line by line for the subs. One line investment for associates. Ash for grease, the head, drop the